This is Introduction to Investing Part 2. I'm not going to waste too much time on the introduction here. I'm just going to jump right into it. Let's get started. Measuring the returns on your investments. There's a simple equation that you can use to measure the return on your investment. It would be returns equaling the price of the investment at the time that you've sold it minus the price of the investment at the time that you bought it, divided by the price of the investment at the time that you bought it. Underneath this equation, you can see R equals the return in the form of interest, P equals the price, T equals the time of the investment at the time it was sold, and T minus 1 is the time of the investment at the time it was purchased. So let's say, for instance, you purchased the investment at $8,000 and the price of the investment at the time you sold it was $10,000. So what you're going to do is subtract the $10,000 or the $8,000 from the $10,000 to get $2,000, and you're going to divide that by the original price that you bought the stock or the investment, which is $8,000. And $2,000 divided by $8,000 is 1/4 or 25%. So your rate of return on that investment is a 25% return. If there's dividends or a coupon on this particular investment, you're simply going to add in this equation D, which stands for dividend income or coupon income, whatever the case may be. The equation is return equals PT minus PT minus 1 plus dividends divided by the price of the investment at the time that it was bought. There's an example at the bottom. We're going to use the numbers from before. You initially bought the investment at $8,000, you sell it at $10,000, and you received a total dividend income of $1,000. So here, 10,000 minus 8,000 is 2,000, plus your 1,000 from your dividend income. So instead of in the last slide it being 2,000 divided by 8,000, it's now 3,000 divided by 8,000, which the return is roughly around 37.5%, as opposed to the 25% in the last slide. And that's the simple equation of how you recognize your returns when a dividend is involved in your investment. Trying to develop an understanding of where your wealth will be in the future, we're going to go back to the concepts that we went over in the time value concepts or the time value series class earlier, which was part 3, I believe. We're going to go back to future value and future value of an annuity concepts to look at your wealth in the future, so to speak, when you're talking about investments. Here down at the bottom, if you want to know the future value of an investment, which is the same thing as the future value equation that we seen earlier, the future value of an investment is simply the investment multiplied by the future value interest factor. Again, like I said, this is a very simplified equation. We're going to try to make it as simple as possible with these equations for the duration of this particular course. And if you want to go into more advanced methods of calculations and things of that nature, we will have other courses on that. To find the future value of an annual stock or a stock that has dividends, what you're going to do is you're going to multiply that annual investment times the future value interest factor of the annuity. If you forgot any of these concepts, please go back and look at the part 3, the time value concepts, so that you can get a better understanding of this. In any type of investment, there is uncertainty. Uncertainty means that there is a possibility that you're going to lose money, or the company is going to default and you're going to lose everything. There's a trade-off between risk and return. If something's typically going to have a higher return, it's also going to have a higher risk. Your goal in investing is try to minimize risk as much as possible while achieving the highest possible return that you can get from that particular investment. Measuring risk. There's two ways of measuring risk, or two ways that we're going to go over of measuring risk in this particular video. One is the range of returns, which it means the returns of a specific investment over a given period of time. Example right here, you have monthly returns last year that range between 0.7% and 2%, and another investment that ranges between negative 2.1% to 9%. The range from the first example, the 0.7 to the 2%, it's a lot slimmer than the second one. And because the range is smaller in the first example, that particular stock is deemed to be less risky. Another way of looking at it is a standard deviation, which is the degree of rapid changes in a stock returns over a period of time. So if a stock is highly volatile over a given period of time, it's considered more risky, although you could receive a lot higher rewards from that particular investment. Ultimately, it's a lot more risky if the volatility is higher and more rapid. Anytime you make an investment decision, you should always take into account a couple of things. Your personal risk tolerance. If you are risk adverse more so than someone else, do not try to invest in a high growth stock which has the potential to return 47-57% annually if the company does not have good financial statements. You also have to take into account what you're trying to do with the money. Are you trying to maintain a certain level of liquidity, or are you investing for a retirement? Always try to remain realistic about your investment decisions. If you're not realistic, it can be very dangerous. Investing in a property that you think is going to be worth $200,000 just by putting $50K in it, and the market isn't exactly stable, like currently with the housing market, it could be a bad investment. You could lose all of your money or half of your money. The house could go down to $25,000, for instance, and if that's your personal savings or your savings for retirement, you just wiped out half of your assets. And always stay ethical with your investments. If you're in debt, try to pay off your debts. Don't take the money to paying off your debts and trying to put it in an investment if it's not guaranteed. This is the end of Introduction to Investing Part 2. Again, we're going to expound a lot more on concepts on bonds and stock valuations in the up and coming videos. I appreciate your time. I appreciate you guys listening in. I look forward to seeing you all in the next slides. Take care.